If you're in Australia on a working holiday visa, you're probably wondering, how does tax work? Do I get a refund at the end of the year, or does the ATO keep it all? Let me explain all things working holiday maker tax in Australia. So let's start with, who does this actually cover? So a working holiday maker is a 417 or a 462 visa. And this could be from a various range of different countries. Now, there are some NDA countries, so these include Chile, Finland, Germany, Israel, Japan, Norway, Turkey, and the UK. Now, if you're from any of these countries, I will talk about it later because it can work slightly different for you. But for everyone else, this is how it works. So the great thing is it's quite simple because it's a flat rate of tax. So for most working holiday makers, they earn between $0 and $45,000 and they'll get taxed at a flat rate of 15%. Now, if you do go above that $45,000, there is a bit of a tiered table here. So you see from 45 to 135, it's 30%. From 135 to 190, it's 37%. And then anything over 190 is at 45%. So it is a flat rate of tax, which means that your refund is normally quite easy to work out because it's going to be a flat rate based on your deductions. So it's really important that you let your employer know that you're on a working holiday maker visa, because they need to register themselves as an employer of working holiday makers, and they need to make sure they're taxing you at these correct rates, because there is no tax-free threshold for working holiday makers. So unlike typical residents, you don't get a tax-free threshold. You're going to be taxed from that first dollar of earnings. So it's really important that your employer gets a tax withholding right throughout the year so you don't get left with a nasty bill. This is also really important if you're going to go over $45,000 from multiple employers, that you need to be aware that this could mean that your employers are still taxing you at that flat 15%, but your tax rate has actually increased and you may end up with a tax bill at the end. Now, most working holiday makers are classed as a non-resident. It means that they don't get those residency tax rates. It also means they're not eligible to pay the Medicare levy. So it has pros and cons. So do you have to lodge a tax return if you're a working holiday maker, and how does it work? So if you're a working holiday maker and you earn less than $45,000 and that is your only sources of income, then you don't have to lodge a tax return. You do have the option to lodge a tax return, but it isn't compulsory. Now, if you want to claim any deductions, you have ABN income, or you've earned over $45,000, then yes, it is compulsory for you to lodge a tax return. Now, lodging a tax return can be quite simple. You can either do it yourself through the MyTax system, through your MyGov account, or you can go to a tax agent. If you're lodging your own return, it'll be due by the 31st of October. If you're using an agent and you're on their list prior to that, you could get until the 15th of May the following year to lodge the return. Now, don't expect anything crazy when it comes to a refund. You might hear stories from colleagues that are on other types of visas or maybe permanent residents that are getting these huge refunds. But this is very unlikely as a working holiday maker. And the reason for that is because of that flat tax rate of 15%, your employer normally gets your tax withholding pretty much perfectly, almost to the cent. Now, you may have some deductions to claim, but those deductions are only going to be claimed at that tax rate. So for instance, we give the example of someone who earns $30,000 of income. Now, when they go to lodge their tax return, they might have $750 worth of deductions. So they claim these deductions in their tax return, which does mean that if their withholding was right, they will get a little refund. But because their tax rate is only the 15%, that refund is only going to be $112.50. So you need to keep in mind that if your deductions are only small, you're only going to get back at the rate of tax that you're at, which is normally going to be that 15%, which means your refund will normally be quite small. A lot of working holiday makers are also in jobs where they're not going to have a lot of expenses out of their own pocket, because they're quite often working jobs such as in hospitality, or maybe they're doing a farmhand job where everything's provided for them and they don't have much expenses to claim. Claims still work the same way as any other residents when it comes to what is claimable or not. These deductions need to be related to your work-related income. I've got lots of other videos on my channel where I do talk about this type of stuff. And if you're looking for more one-on-one help with actually completing your return, my accounting business, Rooshock Accounting, we do hundreds of working holiday maker tax returns every single year. So if you need help, all the links to our website and how to get in touch with us are in the description of this video. So at the start of the video, I did mention NDA countries. So I'll recap here as you'll see on screen. So these are Chile, Finland, Germany, Israel, Japan, Norway, Turkey, and the UK. And this all comes from a 2021 court decision that ruled that a British citizen should have been taxed under Australian residency rates rather than the working holiday visa rates. So to meet the eligibility here, you need to have held a working holiday visa, became an Australian resident for tax purposes, and you're a citizen or national of an eligible NDA country. So this is a really important decision because it can be really beneficial for you. So of course you need to tick those boxes. But if that is the case, you will pay tax on the lower amount that's either on the same basis as a resident national earning the same income, the same circumstances, or as a working holiday maker. So you will get the option to be taxed on whichever works out lower for you. So this is really important. If you're from one of those countries, your tax may be different. You may need to speak to your employer about this so that tax withholding more aligns to what your final situation will be. Now, there are some other things that you need to consider if you're on a working holiday visa when it comes to tax. So one thing is, if your visa changes, your status changes, maybe you're going to move to a temp resident or maybe even a permanent residency, they need to understand that your tax situation could change. You need to let your employer know straight away and need to know that your tax return in that year where there's a changeover could be a little bit more complex. So you may want to seek the services of a tax agent to make sure you're getting things right. The other thing is your super. So when you leave the country, you may be entitled to a departing Australia super payment where you can get your super paid back out to you. Again, this is something you may be able to do yourself or may be able to engage the tax agent to help you. And of course, any other tax related things that could impact you, you want to make sure you're doing that research. The ATO is a great source of information for this. They have a really good website where you can get a lot of detailed information. But one other thing that you really need to understand is what is actually claimable for you. Now, in this upcoming video, I'll go through 20 different deductions that may or may not be claimable. I'd recommend you go watch that one and go through each of these and see if any of these apply to your personal situation.